there. But Simeon, let me just go back to you just in terms of some of the sectors here that you are favoring as investors try to position their portfolios, not only because of what we're seeing play out on the screen right now, but also from the results out of Georgia. Are you making any changes as a result of that?
No, I think we're where we've been for several months now, which is as we look into 2021, there are a couple of pieces of folks' portfolios that we think would work well together. One, this whole question of rotation to value. We think the better play here is rotation to quality. For us, one way of achieving that is through consistent dividend growers. They're almost as cheap as value stocks and much higher quality with higher returns on assets and even higher yields these days. So that's a good piece of a core portfolio that can withstand the near-term bumps, but also take advantage of what will be very likely an end to the pandemic, even if it's not till the second half of the year. But to accompany that, we don't suggest giving up on growth entirely. The opportunities in growth, from our perspective, need to be tied to trends and secular opportunities, some of which have been accelerated by the pandemic, but are likely to continue beyond it. A favorite example for us is online retail as an example. In this entire period of lockdown and semi-lockdown, only 14% of retail sales have actually been online. There's a lot of growth there. So a combination of quality and thematic growth opportunities we think is a good portfolio for 2021.
Right, and I think we got your audio situation worked out. So I'm going to toss it to you on the same question that we were talking about earlier. Just what do you make of the market's reaction to the unrest that we're seeing on Capitol Hill and the fact that the Dow and the S&P are both in the green? The Dow is still up over 400 points.
Well, I think the market has underestimated the House and Senate becoming Democratic. You're certainly seeing a rotation trade today. We've seen this before for short periods of time, but now as a result of what's going on in Congress, this actually might have some legs to it. As a result of significantly more stimulus, which is now imminent, you have a reflation trade potential, higher rates as somebody discussed before, off a low base, albeit, and a weaker U.S. dollar. So what does that mean? More favorable for commodity stocks, financials, emerging markets, small cap, and industrials. And we're seeing that on a very short-term basis. We have leverage products just like ProShares does. So from a tactical standpoint, we're seeing a lot of traders take short-term positions today, both in long financials, triple leverage, FAS, as well as taking the opposite side, FAZ, which is our triple leverage bear.
We want to bring in Jared Lickery. We're just around 2 minutes here from the closing bell. And Jared, as we do see stocks off the highs of the day, energy and cyclicals here leading some of the declines earlier, what are you watching into the close?
Well, let's go straight to the Wi-Fi Interactive, and you can still see a lot of green here in the U.S. indices. Dow is still up 1.5%. The Russell 2000 up 3.7%. These markets had been up a little bit higher earlier, but really not off their highs as much as a lot of people would have thought. Now, the big tech losses have accelerated. We're seeing Apple now down over 3%. And we can see it's making new session lows right now. Microsoft, let's take a look at software because they've had some issues since the new year. That's down to session lows, new session lows. And we're also taking a look at Facebook. And Facebook is not at its session lows, but down back to 2.8% down for the day. Now, some of the winners here, well, Tesla has nothing to do with the current situation, but it is off of its highs here. And just looking at the sector action, we can see financials still at more than 4%, along with materials, energy and utilities, industrials, healthcare, discretionary. All of those are still outperforming. So despite the dire situation in Washington right now, not really seeing it reflected too much in the markets. And that's because a lot of the times these disturbances usually only cause market disruptions over a few days max. They tend to be mean reverting. So I think the market is still pricing in a transition of power, a peaceful transition of power on the 20th, even though it's not peaceful right now. Now, just checking in on some of the bigger sector movements of the day, we can also look at the banking sector. Excuse me, there we go. JP Morgan off of its highs here, still at more than 4.5%. Bank of America up 6%. So the value in cyclical trade and the rotation into it continues. And here is the closing bell on Wall Street on an incredible day here.
Incredible is right, Jared Lickery. You're watching Yahoo Finance Live. Here's where we expect the markets to settle. The S&P 500 will be up about 20 points The Dow is going to be up more than 435 points, almost 1.5%. Nasdaq, however, is going to be off more than 75 points, which is a little more than 0.5%. As Jared was just saying, some of the sectors which performed very well today, materials up about 4%. Also, financials up more than 4%. Energy was up 3%, still getting a boost from the Saudi announcement that they intend to cut back production in the new year. That gave a boost to oil. Energy, again, up about 3%. Some of the sectors which were in decline today, communication services, along with information technology and the real estate sector. It's a lot to break down on an historic day, and we're going to continue to do that with our guests. Simeon Hyman from ProShares Global Investment Strategist, and Ed Egilinsky, Direxion Managing Director and Head of Alternatives. Ed, do you suspect when we hear people like Mark Zandi in the last hour talking about the pent-up demand and the potential for GDP growth of 4%, do you expect that to be reflected in the earnings we will see on the S&P 500? And will we as investors be able to replicate some of the really large gains we got this year based on that?
Well, I think it's going to be more selectivity in terms of where the opportunities lie. I think you're going to have to be more of a stock picker here, look for individual sectors to take advantage of. And as I mentioned at the beginning of the segment, I think there's going to be a shift in rotation in some of the things that outperformed. I mean, we've been talking forever about value finally outperforming growth, or small cap outperforming large cap. Emerging markets outperforming large cap in the U.S. These have been trends for 10 years that have gone basically one way. I think some of what's happening in Congress right now might shift that sentiment.
Hey, Simeon, I'm curious just to get your take on what's going on in the bond market right now, because we had yields rising, breaking above 1% for the first time since March. At what level do you think we would see, or what level would it pose some sort of headwind or some sort of challenge here to stocks going forward?
Sure. I mean, first, from a valuation perspective, if you're at 1% on the 10-year, right on the trend line would be about a 22 for a PE. Now, we're 30 times trailing, but 22 times 2021. So that kind of makes sense. We're assuming we're out of the pandemic. And by the way, to get there, to reach consensus expectations for 2021 earnings would simply require a return to just the margins of 2019 without any extra top line off of what's been experienced in 2020. Specific to your point, what happens if those rates start to rise? From our perspective, if they go up to even 1.5, even 1.75, particularly if that's accompanied by the beginnings of reopening and that GDP growth, that shouldn't be a headwind at all. And the Fed's likely to let that happen in that regard. I don't think you have anything to worry about till you at least see a 2 handle. And I think we're far away from that. But we will slowly start to drift in that direction in all likelihood.
All right, Simeon Hyman, a ProShares Global Investment Strategist, and Ed Egilinsky, Direxion Managing Director and Head of Alternatives. Thanks so much to you two